Okay, so hi everyone. I hope everyone's safe and well. My name is Minh. I work at the Cerritos office. I've been there for about over 2 years. It's a great opportunity because we're given so many opportunities to learn and expand. Since COVID, I've been getting a lot of calls from clients and I've been helping them plan for their future just in case something happens. But today, Swetha and I will be presenting on irrevocable trust. I'm going to give Swetha an opportunity to introduce herself.
Thanks, Minh. Hi, everyone. My name is Swetha. I work with Minh and also the other attorneys in the Santa Clara and the LA office. I've been at Chugh for almost a year now. Tomorrow is my 1-year anniversary, so it's been a great opportunity. I've been working with both the litigation and the transactional teams, helping them with everything that we do. So yeah, excited to present on irrevocable trust today.
Happy anniversary. So I'm here today to explain to everyone what ILITs are, the pros and cons of ILIT trusts, why and when they're used. Swetha is going to talk about the insurance policy and how to fund it, and we'll touch a little bit on administration and termination. So what are the two main types of trusts? I guess the answer's there already, but there are two main types of trusts, revocable and irrevocable. And the trust that would most likely be protected from creditors' claim is irrevocable trust. In 2020, the estate tax exemption is $11.58 million per individual. That's $23.16 per couple. So we have a hypothetical. So Mary, our client, wants to protect her spouse and children following her death. The total value of Mary's estate is close to the exemption. We can say it's about $10 million. But most of Mary's estate is the family residence. Mary's spouse does not work. She makes it's a family with one income. In protecting her spouse and children, Mary doesn't want to incur unnecessary gift, estate, or income tax. What option does Mary have? We can draft an ILIT trust, but even before that, what she can do is get an insurance policy. So there are cases when the client would need life insurance. As I mentioned earlier, Swetha will go specifically into the different type of insurance, but for right now, we just need to know there are reasons why clients would need life insurance. For example, replacing someone's income upon their death. It's a good use to substitute income for loss of income in a client, especially in a family with single income. And especially for clients like Mary from our hypothetical, who's the breadwinner. If she passed away, then her husband won't have any income because they've been relying on Mary's income. If they have a life insurance policy, the life insurance policy would help out. Life insurance can also provide funds to pay for the expense of death. Death can be very expensive. And sometimes the family don't have liquid assets to pay for the funeral expense. This happens when they have a big estate, but the estate is tied to the home or the business. People can get life insurance to ensure the non-liquid asset passed to the beneficiary. So if someone passed away and you're stuck with a big bill, you would have to sell your house at a not so good time. If you have life insurance policy, then there's money and you don't have to sell your house. Life insurance policy can also facilitate satisfaction of gifts. If you want to make sure that your spouse can stay in the house and not have to worry about mortgage, the life insurance policy could help with that. So life insurance is often a key part in estate planning, but they can have substantial estate tax implication. If the grantor owns the life insurance outright, it will be included in the estate tax. And a lot of people don't realize this, they think 11.5 is a lot of money and they don't have that much. But they have a life insurance policy for $3 million. Well, that $3 million life insurance policy will be included in their estate, and that could bring them above the estate tax break. So for clients who is very close to that break, they could get a life insurance and not be the owner of the life insurance, but give the ownership to the ILIT trust. It's also beneficial to have this life insurance ILIT trust if you make more than the break and you want to save some of the amount so you don't have to pay estate tax on the whole amount of your estate. And I just want to point out that the parties are the same when we're discussing revocable trust or irrevocable trusts. We have the grantor or the settlers. They're the ones with the asset and they're creating the trust. Then the other party is a beneficiary. They receive money from the trust. For our ILIT example, the trust is the ILIT and the beneficiary is also the ILIT, and you can name other beneficiary. As long as it's not the grantor, then you're fine. And then there's someone who administers the trust. So what are ILITs? As I mentioned earlier, if the decedent owns the life insurance policy on the decedent's life, the proceeds of the life insurance will be included in the gross estate when calculating the estate tax. But if one creates an ILIT, the grantor doesn't own the insurance policy, so it won't be included. And so the trust owns the insurance policy. The grantor does not, and they cannot change the term. So once the grantor creates the ILIT, they step back. They don't own the policy term, so it gets around the estate tax issue. But the proceeds of the insurance plan won't go to the state. So the next slide talks about why we would want to use an ILIT trust. The main reason, if it's properly structured, we avoid estate tax. It also provides income for the beneficiary, for whoever you want to leave income to. It protects from creditors' claim, and since this is irrevocable, it has more protection than revocable trust. It's flexible in management, and there's privacy. You don't have to file it with probate. So you have some management, but once you set the trust, you step back and you don't control it. So there are some disadvantages of using an ILIT trust. A lot of our clients have problems with not retaining the power to change the trust, changing the trust beneficiary and their interests. ILITs aren't for everyone. In fact, a majority of our clients, I don't think, need ILIT trusts if they're not close to the estate tax amount. They could get, if they're not close to the estate tax amount and they don't need to save this tax burden, they could get an insurance policy and name their estate as the beneficiary. And then the revocable trust will take that policy and distribute it to the regular trust that we've been doing. Another burden or disadvantage of the ILIT trust is some settlers obtained a term insurance policy, and the term insurance policy may expire before the grantor's death. So there's no real point in doing this ILIT if that's the case.
Thanks, Minh. So moving on to the types of life insurance used for ILITs, there are mainly three types: the term life insurance, the whole life insurance, and the universal life insurance. Moving on to the first one. The term life insurance, as the name suggests, is an insurance policy that lasts for a particular term of years and then it expires. The benefit of this is it offers the holder of the life insurance lower premium payments than the other two types. However, it depends. This might not be the best option for an ILIT because, as Minh touched upon earlier, if this is the type of life insurance, it lasts for a particular term of years and then it expires, then the ILIT trust is called into question and it would expire because of the lapse of insurance policy. However, if the settlor is thinking of using a life insurance just as an income replacer for his surviving spouse and family, then this would be a good policy to use. The benefits of a term insurance mainly are it shields the insurance proceeds from estate taxation if the settlor dies during term trust. It allows the settlor to pay only relatively low premiums during the policy term. And it also allows for a limited number of beneficiaries with the withdrawal rights that we just talked about. So it doesn't trigger a certain amount of gift tax. But essentially, this is one of the life insurance that people do use for ILITs. Moving on, the whole life insurance is a more permanent type of life insurance policy that remains in force for the settlor's lifetime. Here, the premiums are paid and they're fixed, either for the settlor's lifetime or for a specific term of years. Here, the policy accumulates into a guaranteed cash value during the insured's lifetime and the premiums are paid. Whole life insurance are a much better choice than term life insurance because it lasts for the entire year, it's more permanent, and it does not result in the lapse of insurance policy. However, the disadvantage is that the premiums here are substantially larger than the term insurance policy, so you would end up making much more higher payments as premiums. Lastly is the universal life insurance. This is another type of permanent life insurance policy, but at the same time, it's much more flexible because here it gives the owner of the policy the freedom to reduce the death benefit during the life of the policy or to increase it by submitting another medical exam. At the same time, it also allows the owner of the policy to change the amount and the frequency of the payment. They can either make larger payments during the early years, or they can even make lump payments towards the end. It also, just like the whole life insurance, it accumulates cash value during the insured's life. So this is also generally regarded a good choice for an ILIT trust. And again, doesn't have the same disadvantage as a term life insurance because it doesn't lapse, and it's more permanent and lasts for the entire lifetime of the insured. Moving on to the owners and beneficiaries of the insurance policies, regardless of whoever owns the policy, the ILIT should be the owner and beneficiary of the insurance policy. If the settlor, he has the option to do two, either transfer the ownership from an existing policy or he can have the trust get a new policy of its own. If he transfers it from an existing policy, then the beneficiary and the owner of the policy must be changed to the ILIT. However, if the ILIT is funded with a new policy, then there is no ownership interest of the settlor. It's the ILIT itself, and they become the owner, or the trust becomes the owner of the beneficiary. The trustee here is responsible, as we discussed earlier, to pay the insurance premiums, to make sure all the beneficiaries are given their rights, their withdrawal rights for taking the money if they require, so the beneficiaries of the ILITs are usually individuals or entities. You can have the trust itself be a beneficiary, as Minh previously discussed, or you could have certain individuals who will receive the proceeds of the insurance policy. However, the grantor or the grantor's estate should not be named as the trust beneficiary. However, the trust in itself would be the owner and beneficiary of the policy, but for the beneficiary of the trust, it should be separate people. It should not be the trust itself. Some examples are you can have your surviving spouse, you can have children, you can have any remote descendants or family friends. You can also have charitable organizations be the beneficiaries of the trust. So choosing trustees. This is also another important aspect of the ILIT because choosing the trustees is the main reason for managing the trust assets. And if we end up choosing the wrong trustee, then the trust may either lapse or it might get into trouble if they do not fulfill their considerations. So to obtain estate tax benefits, the grantor can never be the trustee. The proceeds of the insurance policies are always excluded from a settler's trust because the settler should never have power of the life insurance policy after it's been funded to a trust. So that is the main reason why the ILIT would be the owner and the beneficiary of the insurance policy. However, if the settler serves as the trustee, he will retain the powers to cause that policy to be included in the settler's estate, and that would give rise to certain estate tax payments to be made thereafter. So associated with the choosing of the trustee is the responsibilities of a trustee for an ILIT. There are various responsibilities. The main one is payment of the insurance premiums and on time and from the appropriate source, because you do not want the ILIT to lapse because of non-payment of insurance policies and insurance policy premiums. Second is to ensure that the beneficiaries are aware of the withdrawal rights, and this is where the notice comes into play, because the trustees have to make sure that the beneficiaries are aware of these rights and they have a reasonable amount, which is usually, it depends, it's between 30 to 90 days where the beneficiaries would have the right to withdraw their to exercise their withdrawal rights. The trustee is also responsible for choosing the appropriate life insurance policies. From the three different types that we discussed earlier, the trustee is responsible for either choosing the term, whole life, or universal life insurance. The trustee also has to manage the trust assets such that in relation to the premiums being paid, you have to make sure that trust assets are being maintained. The trustee is also responsible for investing the trust assets once the policies are paid out, so as to have effective distribution of the trust properties under the terms of the trust. That is one of their fiduciary duties. They have to work with the beneficiaries of the trust such that the beneficiaries receive the benefits of the trust and their benefits are not lapsed. Depending on the income tax requirements, they have to file necessary tax returns and maintain all documentation and accountings of the trust assets so as to not result in any tax implications. Very closely associated with this trustee's right is the payment of insurance premium. Here, life insurance premiums can be paid in three main types. One is endorsing a check from the settler to the insurance company. They can either open a trust checking account and make payments directly from that account, so it's completely different. Or they can even make the payments directly to the insurance company. This is by paying when the settler is the trustee. And that is an option because it allows the settler to directly pay the insurance policy company and not have the trust involved. Rights would essentially be an agreement between the settler and the beneficiary. They can choose whether they want to withdraw the amount, and if they choose not to withdraw, then it will stay in the trust and it will accumulate in the trust. However, if they do choose to withdraw, then it will be a maximum of 15,000 per year. Well, you can't really do that because these are rights that are given under the statute as well as case law. So it is not up to the settler or not up to the trustee, but up to the beneficiaries to choose whether they want to withdraw. And if they choose to withdraw and the settler doesn't allow them, then they can file the Crummey letter and exercise their Crummey powers by filing it. That I will pass it back to Minh to discuss the tax aspects of the ILIT trusts. Minh, back to you.
Thank you. We cannot have a requirement. Make sure it's not written. If you want to threaten your kids, just make sure we don't know about it.
Yep.
So the next slide is the ILIT and Gift Tax. So gift tax liability on an ILIT may arise in two different situations. The grantor faces a potential gift tax liability if the grantor transfers from an existing life insurance policy to a new life insurance policy and name the ILIT as the beneficiary. To prevent this from happening, it's advisable that we create the ILIT trust and then the ILIT fill out the application for the insurance policy. There is also a gift tax issue each time the settlers transfer cash into the ILIT to make the premium payments. So that's why a lot of people just do it at $15,000. So with ILITs and estate tax, if the insurance trust isn't properly drafted or administered, the estate tax benefit won't apply, and the proceeds will be included in the grantor, the decedent's gross estate. So this happens in a couple of circumstances. For example, the settler doesn't fill out the paperwork correctly, and on the insurance paperwork, name the settler, retain power, retain ownership, or fail to name the ILIT as a beneficiary, then we lose that estate tax break. Another issue is if the settler transfer an existing life insurance policy to the ILIT, and then the grantor dies within 3 years, then it may not escape the estate tax benefit. So for ILITs and income tax, the grantor is treated as the owner for federal income tax purposes. So as long as the grantor is still alive, again, you don't have to file or request another tax ID. But a lot of banks, when you fund it, they will request an EIN, but it's not required with the IRS. And ILITs generally don't generate income because the grantor funds the ILIT and put it in the bank account, and it's very short term, just enough for the beneficiary to withdraw or to leave it in there. There's not much income generated, so there's no real issue with income tax. So once the grantor is alive, you don't have to worry about income tax, but when the grantor passes away, then it's a separate tax entity, and you have to file for and request a tax ID number. And that's when you file the income tax for the trust. So as we mentioned, and what makes this type of trust so good is that it's irrevocable. So it protects from creditor and all that good stuff. But there are situations where the settlers can keep some sort of power. This can be done, so the settlers can't amend, revoke, terminate, or alter the trust, but you have to draft it in a way where if there's unanticipated change, then the trustee can decant the trust. And trust decanting is allowed. It's something that the trustee can say, we like this part of the trust, and now we're going to create another trust, and this part of the trust we're going to keep in the ILIT. That's all the slides for today's presentation.